Motorcycle prices are collapsing at a speed no one's seen in 20 years. Dealers are drowning in unsold bikes, and desperate discounts are everywhere. But this isn't just a buyer's market, it's an industry crisis. Stay with me until the end, because the real story here could change how you buy your next bike. Motorcycle prices hit rock bottom. In 2025, the motorcycle market is in freefall. Retail prices across major brands have fallen faster than at any point in the last 20 years, outpacing inflation and shredding dealer margins. Industry tracking reports show average new bike prices down by more than 12% year-on-year, with certain sport and cruiser models plunging by as much as 18%. Inventory, meanwhile, has surged to record highs. The National Powersports Dealers Association notes that in January alone, dealer lots were holding enough unsold stock to cover 5 full months of sales at current demand levels. What is driving the collapse is a brutal mismatch between production and appetite. Manufacturers ramped up output in 2023 and 2024 to meet what they thought was post-pandemic demand, only to be met with a consumer base now hesitant to commit to big-ticket leisure purchases. Warehouses are full and showrooms are crowded with last season's models that refuse to move even with aggressive markdowns. The glut is pushing prices into territory not seen since before the global financial crisis, and it is happening fast enough to alarm longtime industry watchers. For the casual observer, the numbers may just be statistics. For those inside the trade, they are the warning lights of an oncoming storm, one that is already beginning to hit the people on the showroom floor. And the first to feel it are the small-town dealers. The month that broke a dealer. On the edge of a Midwestern highway, a small dealership that once sold 50 motorcycles in a good month now struggles to move 5. The owner, a second-generation bike seller named Tom, has been in the business since the early 2000s. This March, he watched as brand-new bikes gathered dust in the front window, their chrome losing its shine under fluorescent lights. He cut weekend hours to save on wages. He delayed his own paycheck to cover the salaries of his 2 sales staff. The phone barely rang, and when it did, it was usually a customer asking if he could match an online listing from a dealer 3 states away, offering thousands off the same model. It is not just about numbers on a spreadsheet for Tom. It is about the weight in his chest when he walks into the showroom each morning, wondering how long he can keep the lights on. His father built this business in the 1980s, weathering recessions and fuel price shocks, but nothing ever felt this relentless. The slow drip of customer traffic is harder to manage than a sudden drop because there is no single event to recover from. Just a grinding erosion of sales, day after day. Tom does not talk about interest rates or trade disputes. He talks about the sound of the shop being too quiet. That silence is spreading, and it is not just in his town. Across the country, a larger set of forces is making that silence the new soundtrack of the industry. If you're already feeling the shock of what's happening in the motorcycle world, hit that like button so more riders see this. And drop a comment. Tell me how prices are hitting your area. I'm reading every one, and your story could be in the next video. A perfect storm is killing sales. The motorcycle industry is colliding with a cluster of economic headwinds that few saw aligning this sharply. Interest rates remain at their highest levels in more than 15 years, raising the monthly payments for financed bikes beyond what many casual riders are willing to accept. At the same time, consumer sentiment surveys show a marked increase in caution toward discretionary purchases, particularly in the leisure and recreation sectors. The combination is toxic. Even customers who could pay in cash are hesitating, sensing better deals may be coming if they wait. Then there is the trade environment. In late 2024, several markets imposed or threatened new import duties on motorcycles, creating uncertainty over pricing and availability. Even though these measures were aimed at cross-border competition, the ripple effect has been to make manufacturers more conservative about where and how they ship product, which has created imbalances in dealer supply across different regions. The result is excess stock in some areas and shortages in others, distorting the market further. Add to this the gradual but steady rise in operating cost, from energy bills to shipping rates, and you have a sector where profit margins are being squeezed from both ends. Dealers are caught in the middle, but another factor is about to cut them even deeper: the tightening grip of the finance industry on motorcycle lending. Dealers are drowning in unsold bikes. I've rounded up the biggest discounts you can grab right now. Check the list in the description below. When the bank says no. In past downturns, dealers could lean on attractive financing to keep sales moving. Zero-down offers, low annual percentage rates, and flexible payment schedules often bridge the gap between buyer hesitation and a signed contract. In 2025, that safety net is unraveling. Banks and credit unions have tightened lending criteria, demanding higher credit scores and larger down payments. Several lenders have pulled out of the motorcycle segment entirely, citing increased default risk. For finance managers, this is a nightmare scenario. One in-house manager at a large multi-brand dealership described losing 3 sales in a single weekend because all applicants were rejected. It is not that the customers were completely unqualified. In many cases, they might have been approved just a year ago, but underwriting standards have shifted abruptly. The fallout is immediate. Walk-ins who cannot secure financing leave empty-handed, and dealers are left holding more unsold stock. This squeeze is not just affecting new bikes. Used motorcycles, which often rely on dealer-arranged loans as well, are seeing slower turnover. Without the ability to offer affordable monthly payments, dealers are reduced to pushing cash-only deals, a far smaller market segment. The link between consumer credit and dealer viability has never been more obvious, and as the lending landscape tightens further, the options for keeping sales alive grow fewer. Somewhere, someone will have to break this cycle, or the market will keep spiraling. And the first attempts to do so are already underway. Big brands slash prices overnight. By the spring of 2025, major motorcycle manufacturers began taking a step they had avoided for nearly a decade, slashing manufacturers' suggested retail prices across multiple model lines. In past years, price cuts were reserved for end-of-life models or overstocks in specific regions. This time, the reductions were broad, affecting both flagship cruisers and mid-tier sport bikes. Industry data shows average list prices from leading brands falling between 6 and 12% compared to the previous year, with some entry-level machines dipping by nearly 15%. The move was driven by more than just goodwill toward struggling dealers. Executives understood that holding firm on pricing while inventories ballooned would damage not only sales but brand perception. In a market where online forums were already full of screenshots showing steep dealer markdowns, corporate leadership decided it was better to reset prices openly than to watch their products become symbols of unsold excess. Still, the cuts come at a cost. Lower MSRPs ripple through resale values, reducing the trade-in equity customers can bring to the next purchase. That, in turn, risks locking some owners into longer cycles before upgrading, slowing long-term demand. For now, though, the short-term goal is clear: move the metal, free up the floor space, and restore a sense of urgency in the buying public. But as these new prices take hold, the burden they ease for some dealers is barely a relief for others, especially those suffocating under inventory loans. Drowning in debt and unsold bikes. In a mid-sized city, Mark runs a franchise dealership carrying 3 major brands. His showroom is spotless, the service bays hum with activity, and yet he is weeks away from breaching his credit covenants. Like most franchise operations, Mark relies on floor plan financing, a revolving line of credit used to purchase new inventory from manufacturers. Every bike on his floor represents borrowed money, and the longer it sits unsold, the more interest accrues. In 2024, this was manageable. Units turned over fast enough that carrying costs stayed within reason. In 2025, with sales volume down by more than a third, the math no longer works. Each month, he writes checks to the bank that eclipse his gross profit. He has begun rotating display bikes from the back to the front just to make it look like new stock is arriving, all while negotiating with lenders for temporary relief. Mark admits that the stress is physical. He wakes in the night calculating what he could get for the building if he had to sell, running scenarios in his head that all end with the same truth. Without a drastic change in market conditions, he will be forced to close or consolidate. Manufacturers may be cutting MSRPs, but that does not erase the debt tied to every unsold unit. For some, the solution lies not in price tags, but in changing how motorcycles are sold altogether. Why some brands are skipping dealers. As the sales slump deepens, certain forward-looking brands are experimenting with a direct-to-consumer model that sidesteps traditional dealerships. Instead of shipping large allocations to be displayed and financed on dealer floors, manufacturers are taking online orders and delivering bikes directly to buyers' homes or designated pickup centers. The goal is to reduce carrying costs and minimize the risk of overstock in a weak market. This shift has precedent in the automotive sector, where electric vehicle startups normalize the idea of configuring and ordering a vehicle entirely online. In the motorcycle space, it represents a more radical departure from decades of reliance on local dealers as the primary customer touchpoint. The benefits are clear for the manufacturer. Reduced reliance on dealer incentives, tighter control over pricing, and the ability to match production more closely to confirmed demand. Not everyone welcomes the change. Dealer associations argue that bypassing showrooms undermines the service and community aspects that help sustain motorcycle culture. Executives counter that in a digital-first retail world, community can be built online just as effectively. Whether this is a temporary response to the downturn or the beginning of a permanent transformation remains to be seen. Either way, this evolution intersects with another critical battleground in the industry: the fate of electric motorcycles, which were once seen as the growth engine for the next decade. Electric dreams meet harsh reality. Just a few years ago, electric motorcycles were the sector's most celebrated growth story. Generous purchase incentives, expanding charging networks, and bold marketing promised to bring a new wave of riders into the fold. In 2025, that optimism has cooled. Sales data shows that while electric models still outperform the overall market in percentage terms, their absolute volumes remain small. Even with subsidies, high upfront costs and limited model variety keep adoption rates modest. Government support has cushioned the blow. In some states and countries, rebates can shave thousands off the purchase price, but they have not fully overcome concerns about range, charging time, and resale value. Competing against internal combustion models now heavily discounted by both dealers and manufacturers, electric bikes are struggling to justify their premium. Some brands have resorted to stacking dealer incentives on top of government subsidies, effectively reducing net prices by over 20% in certain cases. Industry analysts note that the long-term case for electrics remains strong, particularly as battery technology improves and more urban areas adopt low-emission zones. In the short term, though, they are caught in the same gravity as the rest of the market: hesitant buyers, economic headwinds, and an oversupply of alternatives. The fight for the future of two-wheeled transport is far from settled, and the political winds now blowing into the industry may decide its direction faster than technology can. 50% tariffs wreck Harley sales. In February of 2025, the European Union announced a new round of retaliatory tariffs targeting American-made motorcycles, most notably Harleys. The headline figure, 50%, stunned dealers and customers alike. Overnight, price tags in certain EU countries surged to levels that defied logic. In Denmark, a high-end touring model that retailed for around 40,000 euros in January now listed for nearly 60,000. In niche cases where local taxes compounded the tariff, the sticker price soared to the equivalent of $124,000. For dealers like Lars in Copenhagen, this was not just a business challenge, it was existential. These bikes are now luxury collectibles, not transportation, he explained, standing in a showroom where the gleaming machines might as well have been encased in glass. Sales inquiries dropped to zero. Pre-orders evaporated. Even the most loyal Harley enthusiasts balked at the new cost. The tariff was framed by Brussels as a proportional response to unrelated trade disputes over industrial goods, but the motorcycle sector became a high-profile casualty. It left European dealers stranded between corporate pricing policy and political hardball. And while EU policymakers talked about future negotiations, the immediate reality for Harley's European network was bleak. Across the Atlantic, the sense of industry-wide vulnerability began to fuel new forms of activism among American dealers. The dealer family that won't give up. In a small Wisconsin town, 3 generations of the Granger family have run a Harley dealership since the 1960s. The walls of their showroom are lined with photographs of riders, rallies, and parades, living proof of a dealership's role as a community hub. But in 2025, that community feels under siege. The tariff news from Europe landed like a gut punch, even though their own customer base is domestic. It was another reminder that global politics can slam into local livelihoods without warning. The Grangers have weathered oil crises, recessions, and corporate restructurings, but the current downturn feels different. It is slower, heavier, and paired with a cultural shift where younger riders are harder to attract. They have seen foot traffic decline steadily over the past year, and the stories filtering in from fellow dealers, floor plan debts, evaporating financing, unsold inventory, are taking a toll on morale. Rather than retreat, the Grangers and other veteran dealers have begun organizing. Informal networks are turning into coordinated dealer alliances, sharing strategies and even planning joint promotional events to draw customers back. There is talk of a national dealer rally in Washington to highlight the crisis, not just for Harleys, but for all motorcycle retailers. And that growing sense of collective action is catching the attention of another powerful player in the industry's labor landscape. Unions enter the fight. The slowdown in motorcycle sales has not spared the workers who build, ship, and service the bikes. In January alone, union representatives estimate that more than 1,000 positions were cut across assembly plants, parts suppliers, and distribution hubs. Many of these layoffs hit in smaller towns where motorcycle jobs are a cornerstone of the local economy. Maria Torres, a regional leader for a transportation manufacturing union, has made the crisis a central focus of her organizing efforts. She argues that the downturn exposes structural vulnerabilities, too much dependence on cyclical luxury spending, too little investment in workforce retraining, and supply chains that are too concentrated in a handful of facilities. We cannot let this become another case where an entire community fades because the factory goes dark, she warns. Unions are lobbying state and federal officials for targeted relief, not just for dealers, but for the broader network of workers tied to the industry. Proposals range from temporary payroll subsidies to tax incentives for manufacturers who maintain domestic employment levels through the slump. The push is gaining some traction, but skeptics note that it faces the same budgetary and political hurdles as any industrial aid package. As unions make their case, analysts are beginning to place the current downturn in a longer historical context that offers both caution and precedent. Is this 2008 all over again? For economic historian David Rowe, the parallels between the motorcycle downturn of 2025 and the auto industry collapse of 2008 are striking. In both cases, a combination of credit tightening, consumer hesitation, and inventory overhang created a downward spiral. Dealers back then, much like now, found themselves stuck with stock they could not move and financing terms that grew harsher by the month. Rowe notes that in 2008, the crisis reached a breaking point when major automakers faced insolvency, triggering government bailouts and a wave of consolidation. While the motorcycle sector is smaller and more fragmented, it is vulnerable in similar ways. A few large manufacturers dominate production, and a collapse of even one could send shockwaves through suppliers, dealers, and local economies. The historian also points out key differences. In 2008, pent-up demand returned more quickly once credit conditions eased, helped by large-scale government intervention. Today, demographic shifts and the rise of alternative mobility options mean that recovery could be slower and less complete. The The lessons of the past suggest that proactive measures could shorten the slump, but whether those measures will be taken is still uncertain. And now, as the downturn deepens, the conversation is expanding beyond the past and present to how the ripple effects will shape other sectors and political battles. The discount spiral spreads. The pricing shock that began in motorcycle showrooms has not stayed contained. By mid-year, industries as varied as recreational boats, recreational vehicles, and even used car dealerships were quietly adopting the same aggressive discounting strategies. For boat dealers, the parallel was immediate. Luxury and leisure-focused products purchased with discretionary income were facing the same demand collapse. Large RV chains rolled out mid-season clearance events that in the past would only have been seen at year-end. A multi-industry consultant in Chicago described it as pricing contagion. Once one major sector makes deep cuts public, customers in unrelated markets start expecting similar deals elsewhere. That expectation puts pressure on sellers in other industries, even if their supply and demand fundamentals are not as dire. In the used car market, franchise operators began advertising rebates and trade-in bonuses, typically reserved for new vehicles. The result is a broader shift in consumer psychology. Buyers are learning to wait, confident that if they hesitate long enough, prices will come down. That mindset can extend slumps far beyond the original trigger industry. While analysts debate the long-term risks of this discount spiral, elected officials in certain states have already decided they cannot wait for markets to self-correct. Their attention is turned to the political theater of rescuing what they frame as a cornerstone of Main Street. Politicians turn dealers into a campaign stage. In states with strong motorcycle cultures, governors are seizing the opportunity to position themselves as defenders of local businesses. Press conferences are held at dealership lots, with rows of unsold bikes forming the backdrop as governors pledge emergency relief. The messaging is crafted for maximum populist impact. This is not about corporate bailouts, they insist, but about saving Main Street and protecting the jobs tied to sales, service, and community events. One Midwestern governor's spokesperson explains the framing. When a dealership closes, it is not just a sales floor shutting down, it is a hub for riders, a sponsor for local charities, and a customer for other small businesses. We are protecting a network. Proposed measures vary from temporary tax abatements to low-interest state-backed loans for inventory financing. Critics question whether such interventions risk prolonging structural problems, but the optics of inaction during a publicized slump are politically risky. These initiatives are not limited to motorcycles. Some proposals package motorcycle dealers alongside small automotive lots, marine retailers, and RV sellers, creating a coalition of leisure vehicle businesses under one legislative umbrella. While these plans move through committees, consumers themselves are responding to the crash in their own way, by flooding the market in search of unprecedented bargains, with results that are not always happy endings. Bargain hunters regret. For Mike, a lifelong rider in his early 40s, the price collapse felt like a once-in-a-lifetime opportunity. He had been eyeing a new touring model for years, and when he saw it discounted by nearly 20% at a regional dealer, he drove 2 hours to make the purchase. The rush of excitement was real, until the first service appointment revealed a backlog at the local shop. With so many new owners taking advantage of the deals, wait times stretched to weeks, and parts availability became inconsistent. Other riders share similar stories. Some discovered that aggressive dealer pricing masked hidden fees, extended warranties with restrictive conditions, or models that were already due for a mid-cycle update. Bargain hunters on forums began warning others to read contracts carefully and to check manufacturing dates before signing. In the used market, buyers who thought they had timed the bottom of the price curve found that continued markdowns left them with instant depreciation. Still, for many, the draw of the deal outweighed the risks. The psychological satisfaction of beating the market is powerful, and in the short term, it is helping to move inventory. But in the background, financial markets are drawing their own conclusions, and investors are repositioning portfolios in ways that could reshape the industry far beyond the current slump. Wall Street bets on the industry's future. In the world of institutional finance, the motorcycle industry's downturn has shifted from a temporary blip to a structural re-rating. Hedge funds and private equity firms are shorting shares of publicly traded manufacturers, betting that the combination of slow demand and discount-driven margin erosion will persist for several more quarters. Some asset managers are moving in the opposite direction, quietly building positions in select suppliers and niche brands they believe can emerge stronger through consolidation. Market strategists point to two likely scenarios. In the first, weaker manufacturers fail or are acquired, reducing competition and allowing survivors to rebuild pricing power. In the second, a prolonged period of low prices reshapes consumer expectations permanently, forcing a reinvention of the dealer-manufacturer relationship. Either path will reward nimble players with cash reserves and adaptable production lines. For investors, the volatility itself is a source of opportunity. Daily trading volumes in certain motorcycle-related stocks have doubled compared to the previous year as speculative traders exploit sharp price swings. Long-term pension and index funds, however, are trimming exposure, signaling that they expect the recovery to take years, not months. While Wall Street calculates returns, the industry itself is staring at a future in which the events of 2025 may be remembered not as a passing storm, but as the start of a new era for how motorcycles are built, sold, and valued. If this breakdown opened your eyes to what's really happening in the motorcycle market, don't let it stop here. Subscribe right now so you're first to know when the next wave hits, whether it's deeper price drops, dealer shakeups, or the comeback no one expects. Share this with your riding friends. Drop your thoughts in the comments and let's keep this conversation alive. The road ahead is changing fast, and you'll want to be in the front seat. You've seen how deep this crash goes, and there's still more unfolding. If you want the updates first, subscribe now and turn on notifications. That way, you won't miss the next twist in this story or the one that could land right in your own garage.